The US tax system is not broken. It's working exactly as designed, just not for you. Right now, there are 47 IRS agents whose entire job is to audit people making under $200,000 a year. You know how many are assigned to monitor the top 100 wealthiest Americans? 12. 12 agents for 100 people sitting on a combined $12 trillion. Stay with me, because by the end of this, you're going to understand something that most CPAs spend their entire careers too scared to even whisper about. And yes, there is one number at the very end of this that will make the IRS look like an absolute joke. Don't skip. It's 6:47 a.m. Your office is on the 43rd floor of a glass tower in San Francisco's financial district. The city is still dark below you. Your phone lights up. One message, no name, just a wire confirmation number. $800 million moved through 4 entities you built across 3 countries before most people hit snooze on their alarm. This is your morning now, but you didn't start here. You earned this. Let's go back to the beginning. Level 1. You're a fresh hire at a Big 4 firm. You're billing $280 an hour, running tax returns for mid-sized valley tech companies who think they're being aggressive by maxing out their R&D credits. Cute. Then a recruiter calls. No job posting, no LinkedIn. A private phone call. The client? A founder. You've seen his face on Forbes. Net worth at the time, $3.2 billion. He needs a personal tax architect, not an accountant, an architect. The difference? An accountant records what happened. An architect decides what will happen. Your first assignment is almost insultingly simple. He sold $60 million in secondary shares. His previous team booked it as ordinary income, taxed at 37% federal. Add California, you're looking at 54 cents on every dollar handed to the government. You recharacterized the entire position. Qualified small business stock, section 1202 of the Internal Revenue Code. The shares were held for over 5 years in a C Corp with assets under $50 million at the time of issuance. Every box checked. Federal tax on that $60 million, 0. Legal, clean, done. He made $9 million in 3 phone calls with you. He didn't move a single dollar offshore. You just reclassified it. He trusts you now. And that's when the real work begins. But level 1 was just the warm-up, because he's about to tell you about the real estate portfolio. Level 15. He owns a commercial office complex in Austin. Bought it 7 years ago for $30 million. Worth $52 million today. He wants to sell. He wants to upgrade to a trophy asset in Manhattan. A skyscraper. $150 million. A lesser accountant would say, sell the Austin property. Pay capital gains. Use the net proceeds toward the new one. You say absolutely not. You execute a 1031 exchange. Section 1031 of the tax code allows your client to sell the Austin property and roll 100% of the proceeds, the entire $52 million, into the Manhattan skyscraper. With 0 capital gains tax triggered. The $22 million in profit, deferred. Not forgiven, deferred. Theoretically, he owes it someday. But here's the thing about someday in tax law. Someday never comes if you keep exchanging. He'll 1031 that skyscraper into another property, and another, and another. He'll ride that deferred gain all the way to his estate, where it gets a stepped-up cost basis at death, and the entire deferred tax liability evaporates from the face of the earth. But you're not done with this building yet. You bring in a cost segregation firm. They audit every square inch of that Manhattan skyscraper. The HVAC systems, the electrical conduit, the specialized flooring in the lobby. Anything that qualifies as personal property or land improvement gets reclassified from a 39-year depreciation schedule to 5 or 15 years. Under bonus depreciation rules, your client can accelerate the deduction. Roughly $30 million in depreciation losses hit his tax return in year 1 of owning a building he bought with money he never paid taxes on. He uses those paper losses to obliterate taxable income from his operating companies. The IRS sees a billionaire. The tax return shows a man who, on paper, barely broke even. Legal, documented, bulletproof. But real estate is just the infrastructure, because the philanthropy play is where this gets truly dark. Level 30. Your client has been holding a block of founder shares in his public company since the IPO. Original cost basis? Essentially 0. Current market value? $400 million. If he sells those shares, he owes approximately $90 million in federal and state capital gains tax. That's 90 million reasons to find another way. You introduce him to the Charitable Remainder Trust, a CRT. Here's how it works. He donates the appreciated shares directly into the trust. The trust is a legal entity, not him personally, not his operating company. The trust. Because the trust is a tax-exempt entity, it sells the shares and pays zero capital gains tax. All $400 million stays inside the trust, working. But here's where it gets elegant. The trust is required to pay out an income stream to your client. Let's say 5% annually for the rest of his life. That's $20 million a year flowing back to him, taxed at ordinary income rates as it comes out. But remember, he just saved $90 million in cap gains to get here. The math is obscene. On top of that, he takes an immediate charitable deduction in the year of the donation. Based on actuarial calculations of what the charity will eventually receive, he books a deduction worth tens of millions of dollars against his current year income. And the charity, it's his own donor-advised fund, his family foundation, which he controls, which employs his adult children at six-figure salaries as program officers, which funds the conference circuit his wife runs, which pays for the research retreats in Aspen and Davos that coincidentally his family attends. The money never really left the family. It just changed its tax character. The IRS calls this philanthropy. You call it the cleanest wealth transfer mechanism in the American tax code. He's not done though, because there's still the cash problem. He needs liquidity, and you have a very specific solution for that. Level 50. He wants a super yacht, 230 feet, $78 million. He wants to pay cash. Here's the problem. That cash is trapped inside a Delaware C Corp that holds his operating company equity. If he takes a dividend, federal plus California eats almost half. He'd need to pull out nearly $140 million just to net $78 million after tax. You're not going to let him do that. You structure a collateralized loan. The C Corp pledges a portfolio of publicly traded securities and pre-IPO equity positions as collateral to a private credit facility. The interest rate is set at the applicable federal rate, the IRS's own benchmark rate, currently around 1.2%. The loan proceeds flow to your client, personally, tax-free, because a loan is not income. The Internal Revenue Code does not tax borrowed money. He buys the yacht. He pays the interest, which, depending on how the yacht is documented as a business vessel for charter purposes, may itself be a deductible expense. Now here's the masterpiece inside the masterpiece. He will never repay this loan from income. Why would he? When he dies, his estate inherits the assets at stepped-up basis. The appreciated securities that were pledged as collateral are now valued at death date prices. The loan gets settled against them. The original cost basis, the embedded gain that would have been taxed, disappears. Buy, borrow, die. 3 words that represent the most elegant tax strategy in existence. And it is fully legal. The yacht's name? Basis Step Up. He has a sense of humor. But bringing domestic money back from appreciated assets is one thing. The real complexity is the $4 billion that's been accumulating offshore. And that is a different universe entirely. Level 75, your client's IP portfolio, every patent that generates $300 million in annual royalties, does not sit in California. It never did. Years ago, you orchestrated a transfer. The IP was contributed to a wholly owned Irish subsidiary at a valuation that, let's say, reflected the patent portfolio's early stage uncertainty. Today, those patents print money, but the ownership sits in Dublin. The Dublin entity, operating under Ireland's 12.5% corporate rate, licenses the IP to a Dutch holding company you established in Amsterdam. The Dutch entity, exploiting a participation exemption that shields dividend income from Dutch tax, sublicenses the IP to the U.S. operating company. The U.S. company pays a royalty to the Dutch entity. That royalty is a deductible business expense in America. It destroys domestic taxable income at 37% rates. The royalty lands in the Netherlands. Through the Dutch participation exemption and the U.S.-Netherlands tax treaty, it flows to Dublin at a negligible withholding rate. In Dublin, the profit accumulates. But you've gone one step further. The Irish entity has a tax residency election through a hybrid mismatch structure that makes it a resident of Bermuda for certain purposes. Bermuda has a corporate tax rate of 0%. The money pools in a Cayman Islands account held by a Bermuda-based holding company that is, on paper, a portfolio investment vehicle. It is not flagged as a controlled foreign corporation under Subpart F because the income is characterized as passive royalty income, meeting a high tax exception threshold. The IRS sends letters. Your response? 40-page transfer pricing memoranda. 3 independent economist studies. 1,200 pages of documentation establishing that the Irish subsidiary has economic substance, real employees, real office space, real decision-making authority, making it so expensive and so technically complex to challenge that the examination team closes the file and moves on. This is the double Irish with a Dutch sandwich. The EU tried to legislate it out of existence. You found the successor structure. There's always a successor structure. But offshore optimization is still just technical work. Level 100 is something else entirely. Level 100 is when you stop playing the game and start writing it. Level 100. Your client no longer asks you to hide money. The balance sheet is $16 billion. The structure is so layered, so jurisdictionally diversified, so institutionally embedded that the money isn't hiding anymore. It's invisible by design. He operates through a family office, a private investment vehicle managing assets for a single family, exempt from SEC investment advisor registration below the threshold. The family office holds positions across 7 private equity funds as a limited partner. The returns, carried interest, fund managers, and through co-investment rights, your client, receive a share of profits, taxed not as ordinary income, but as long-term capital gains. 20%, not 37. Congress has tried to close this loophole 17 times since 2007. It has failed every time. Why? Because the same private equity funds your client invests in write checks to political action committees. The same lobbyists who brief Senate Finance Committee staffers on tax simplification proposals are on retainer through a law firm whose managing partner sits on the advisory board of one of your client's holding companies. No direct connection, no paper trail, just a shared understanding of whose interests get protected when tax legislation gets drafted at 2 a.m. on the Senate floor. Your client doesn't just benefit from the tax code, he maintains it. You close your laptop, it's 9:15 a.m. You have a call in 20 minutes with a securities attorney about a new Cayman-domiciled fund structure that captures the IP monetization play post-Dublin restructure. After that, you're reviewing a Singapore holding entity proposal, because tax law shifts and you are always 3 moves ahead. Your retainer this year? $4.8 million. Paid through a professional services LLC. Your effective tax rate? You already know the answer. Here's the number I promised you. Your client's effective tax rate over the last decade, across every entity, every jurisdiction, every income stream? 4.3%. The median American household pays around 13%. A school teacher in Cleveland pays 3 times the rate of a $16 billion founder. And before you decide how to feel about that, understand something. Your client didn't cheat the system, he bought it. The tax code is 4 million words long. It was written by lobbyists. For lobbyists, in the language of lobbyists. The system isn't rigged against everyone equally. It's rigged against people who don't understand how it works. Now you do. The question is, what are you going to do with that?